what we'll do over the next 45 minutes, or maybe even less if we're lucky, is firstly look at what's occupying the minds of insurers, and in particular in the London market. We've got the benefit of having David here, of course. And secondly, we'll drill down into some of the key trends and issues and seek some panel perspectives on those. So, turning to the insurance market, firstly, the London insurance market is a global one, and there's a very good chance that your clients, wherever they are in the world, will have some insurance cover placed in the London market. And needless to say, with world events going on, COVID, Ukraine, there are some very large losses out there, a great deal of uncertainty, and businesses are under significant financial pressure. They're also under pressure to be seen to do and to do the right thing. What is sort of being created at the moment is effectively a global economic downturn as a result of all these factors. And that typically leads to more risks and more claims, which is reflected, I would say, in the insurance market. But David will be better placed than any of us here to tell us a bit about how the situation that's brewing is being felt within the insurance industry and what it also means for policyholders, so many of your clients.
So just in summary, I think we talked in the last session about the economic challenges, the wage inflation as a result, and so on. A nuance to that is what's described as a buzzword in insurance at the moment is social inflation. And by definition, social inflation is always in which insurers claims costs over and above the general economic inflation, including, for example, societal preferences over who is best to absorb risks. So in other words, it's inherent in paying out a claim, what are all of those hidden costs that are not necessarily appreciated at the time that a policy of insurance is written. And to talk about it very simplistically is that if you think of a car manufacturing company or a law firm providing legal services, the car manufacturing company will manufacture a car, and it will manufacture the car and produce a car knowing what the cost to produce that car is. It will then sell that car at a profit, knowing what those costs are. Similarly, for law firms, you'll provide legal services and you'll ensure that your wages for your employees are covered in terms of the remuneration that you will receive. So as a managing partner of a law firm, you can manage that law firm profitably. For a CEO of a car manufacturing company, they ought to be able to run that company profitably. Ask, therefore, whether you would like to be a CEO of a company where you sell a product, but you have no idea if and when that product will be called on, if indeed it is ever called on, and if it is then called on, when will it be called on, and how much will it actually cost? So in other words, that's the policy of insurance that's being sold. With the business that we're in, it's a casualty business, so it's long-tail business, professional indemnity, directors and officers liability insurance, general insurance. It's the type of insurances that Tom was just talking about that underpin much of the work that you do. We will sell that policy of insurance to our policyholders, whether it be a law firm or the car manufacturing company, for the directors and officers. But we do that with a whole actuarial analysis having been done to understand when, by virtue of all of that data, when that policy might be called on, how much it will cost to pay out the claims in due course, and what those claims might look like. Moving forward, and to answer the question about, well, what does social inflation mean? Social inflation means that we're now seeing the cost of those claims increase exponentially, that we, at the moment, can't necessarily understand what those costs might look like if and when a claim actually materializes. And why is that? Well, so for example, you've got plaintiff firms that are aggressively marketing. You have you have juries that are increasingly providing awards that are significantly greater than judges. You have the economic inflation that is alongside the social inflation. So you've got those aspects that are increasing the hidden cost that is causing insurers, and within the London insurance market and worldwide, to appreciate that this concept of social inflation is a real one, and one that ideally we want to be in concert with our legal service providers to appreciate that this is a real reality. Just to put it into context by way of example, a policy of insurance will often be written, and you'll know this for your own home and contents insurance, for example. You have a deductible, an excess that you will pay if you make a claim on that policy. That deductible might be $250 or pounds or euros. With our policies of insurance, there have historically been, say, 250,000 or 2 million, inclusive of defence costs. With wage inflation going up, social inflation going up, inclusive of the defence costs, the burn rate of those costs now is so much greater than what it was when the policy of insurance was written. And that's only going to get worse. So these are the tensions that insurance companies are facing in and around social inflation.
Yeah, I've actually got a really good example. So you might have heard in the press that in Australia we've been suffering from the odd bushfire and flood. Well, what's occurring just in terms of the cost is there are so many houses to be demolished and rebuilt. There's not enough builders around to complete that work over the next 10 years, and the costs associated with building have gone through the roof. Then we've got the shortage of actual raw materials because of global supply issues, and then we've got to accommodate all these people in the meantime. And so this is the real impact for insurers who take out risk contracts, and look, they're in the business of taking premiums off people, but the events like this. So what then happens from a society perspective is that a number of levers are pulled by insurers. They increase premiums, they increase excesses, but where it becomes a real issue for the community is where they just say, no, we're not writing that risk anymore. And so in Australia, we've got a situation at the moment, believe it or not, with cyclones in the Northern Territory, where nobody will pretty much insure properties up in the Northern Territory. So where that's leading is there's actually a discussion between government and the insurers at the moment, where the government will provide a reinsurance fund to the value of $10 billion to encourage insurers to enter back into the market to write the risk, and then they can reinsure the risk out by a government guarantee. But that's the sort of issue that's coming up at the moment in the insurance industry in many sectors. They're as stressed as the business community generally. Yeah.
Thank you both. And actually, just picking up on the bushfire and cyclone example, that feeds into one of the key emerging issues which we've heard about throughout the course of the last 2 days, and that's ESG. So obviously those go to the E aspect. You've also got the S and the G. So obviously big topic in the business world you've got climate change, Me Too movement, lots of increased regulation around how businesses are conducting themselves, how their board is comprised, their environmental impact. And there's been a lot of talk about that within the insurance market, and one of the aspects has been, well, to what extent are directors and managers of businesses exposed to liabilities? And it's been a bit of a thing. Well, is it actually going to happen? Are they going to be hit with lawsuits? And the answer is yes. So we've seen this in the last couple of months in the UK. A shareholder has brought a derivative action against the directors of Shell for breaches of the Companies Act, And the basis for doing so is saying that they have not exercised reasonable skill and care in trying to move Shell towards a net zero position. And that comes off the back of a ruling of a Dutch court that said that Shell had to effectively get its house in order and reduce its emissions. And Shell said, no, that we don't really think that applies to us. We don't think this judgment's any good. Now they're being sued. So the directors are personally on the hook. And from an insurance perspective, you sue a director, they'll have directors and officers insurance. And directors and officers insurance is a real plague for the insurance market, because it often means you're hemorrhaging huge costs on lawyers, which is all great for us, but bad for insurers. So the minute you start opening the floodgates of having the kind of E aspects of ESG risk being claims against directors, you're giving concern to insurers. And it's just, the same around the kind of the Me Too movement, all the EPL, employment practices liability claims. And just one thing to add on that as well, you've got the claims exposure being one aspect of ESG, and then also how insurers present themselves to the market, the public, and who they collaborate with. So I just read in, in fact it was Mark that sent me a snip from the Financial Times that said that Marsh, an insurance broker, is now sort of in a bit of hot water because they are effectively supporting a controversial pipeline project in East Africa. There are loads of banks and insurers that have come out of that project because it reflects badly on them, bad publicity. So that is becoming a real concern for them.
Similarly, all the Australian insurers in their public documentation are all publicly. These are the ones that are paying for the consequences of the climate change. They're all going out on the front foot and giving an indication of when they're pulling out of carbon-producing industries, and it's imminent. It's either immediate or by 2025 and 2030. And just while I'm speaking, if we just pick up on Tom's point, if you do governance advisory for corporations, it's actually a great opportunity for all of us in the room to get on the front foot and actually provide some proactive advice, just making boards of directors and management aware of the potential ESG risk now that's emerging in the world. And we've got a few examples of some cases from active shareholders in Australia who are also bringing ESG claims. So it might be a good business development tool, a good opportunity to get in front of those boards and senior management by assisting in advising on that area.
Yeah. And Erica, is this something you're seeing in Canada? Is it really hit yet?
Yeah, it hasn't really fully hit to the same extent. Definitely with the larger corporations, it's an issue. But I think one of the things as law firms we just want to be mindful of. I'm sure if you already regularly work for an insurer, you are hearing that they want those same requirements from our own law firms. So they want us to be governing our law firms pursuant to those same policies. So if they're looking for an environmental impact, they're going to be saying to you as the law firm acting on their behalf, defending their insureds, to say, what are you doing to reduce your environmental impact? What are you doing on the social front? How are you governing your law firms in a way that matches our own ethics? And so we certainly have faced an issue in Canada where we didn't normally measure how many women work in our firms, how many people of different ethnicities work in our firm. And these are questions now being asked to us by the insurers that we work for. And so we've had to look at it and say, well, is this something we clearly have to do, or do we want to do it? Because we've been operating quite happily. And so our diversity and equity and inclusivity committee has been looking at these issues to make sure that not only are we advising our clients in this way, but are we operating in this way? And so that impacts all of this, because maybe we can't act on behalf of our clients through their insurer if we're not meeting these guidelines. So it's something interesting to look at, whether you're doing that for your client. At first we were looking at it, are we looking at it for our client, the insurer, but also can we continue to act for our individual client as the insured and then also for the insurer. So it kind of increases your ability to work for multiple clients if you're adhering to some of these things consciously instead of subconsciously.
And then
David,
so just to pick up on that, we then look at, okay, if you say you're doing it, how is that evidenced? And that's certainly been picked up in some of the conversations we've had. And we call it greenwashing or pinkwashing. The greenwashing is being E-compliant in all respects, but in name only. Pinkwashing is having your LGBTQ plus inclusive and diversity groups, etc., but it's in name only. And therefore it is supposed to pull the wool over everyone's eyes. It becomes very, very transparent, as we were just saying, when actually the proof is in the pudding.
And just to put some of the managing partners in the room under a bit of pressure, are insurers concerned around who's at the helm? I mean, are there questions in the proposal form that try to interrogate that sort of aspect, so the S and the G in particular?
Absolutely. Yes. In terms of proposal forms out to in policyholders, these are the sorts of questions that are being asked, and honest answers are being required. Similarly, if we were talking about the sanctions issues and the complications that that has for insurers inadvertently insuring an entity or that might be subject to sanctions. It's the same with inadvertently, in due course, insuring a policyholder or having legal services provided by firms that are simply non-compliant. So after COP26, there are a number of sweeping commitments, one of them being that we'll have, by 2050, carbon neutral. Lloyd's insurance market by 2025 wants Lime Street, which is where the hub of the insurance worldwide sits, to be carbon neutral. That's a massive undertaking. So it does mean that we as insurers need to sit down and consider at every transaction, well, is the party before me compliant E-wise, S-wise, and so on? And are then down the supply chain, are they also being compliant? So back to the car manufacturing company, is that end bit actually being mined in a mine that's totally non-compliant in Africa? If the answer is that it is, then you're not going to be successful in carbon neutrality by 2025.
Thank you. So ESG is important not only in relation to claims exposure, but also insurers doing the right thing and partnering with law firms that are doing the right thing and trying to write risks that are ESG friendly. So it's really high on the agenda. A second really key issue for insurers, every single insurer you speak to will mention it, it's the cyber risk. And this has really sort of exploded in the last few years. And it's caused huge losses across the industry, from major incidents to the day-to-day data breaches. Typically in the London market, because we're a little bit slow on things, we look to North America where things have already started happening and look at the trends there. And I don't know, Erica, what's the current status of the, let's say, the cyber threat and the insurance response in North America?
Yeah, I think what I've seen on behalf of my clients, being on the side of not yet engaging the insurer. So when they come to me first for a ransomware attack or a breach, the issue then that we quickly realize is, although they consulted with me 5 years ago on their cyber policy, they didn't reconsult as the policy evolved and changed. And so we're seeing that the policies are in fact carving out different definitions, different exclusions that maybe the insured wasn't aware of. So as someone advising a client on whether they have coverage for a ransomware attack or business email compromise, you really want to be able to understand what those definitions are. And so, for example, we're bringing a claim now, and it kind of comes back to David's point, which is who's better placed to deal with the risk. And so we're making the argument in a business email compromise case that the party better suited to deal with the risk is the one who implemented the policies and procedures, being, he's going to hit me now, the insurance company. So the broker and the insurer and the independent adjuster created a system that dealt with the claims and paid out the claims. And during that transaction, the independent adjuster was compromised, and there was a phishing email that went out from their adjuster to the insured saying, send the money here. And that's the process that they'd always used. And the money went, we don't know where. So we're currently suing that independent adjuster. Sorry, David. And we're saying you were better suited to understand and know the risk of setting up that procedure. And so it was your negligence in setting up that procedure that resulted in this. So there's currently no case law in Canada. We've had two different cases, one in Ontario, one in BC, that said they used the best suited to deal with the risk test, and the other that said, was it contractual? So in this case, we're arguing that there was an implied contract for them to set up a procedure that was safe, but we will see what the courts decide in Alberta. And those are things that I think are really important to really understand the nuances. So before we got to the point of suing the independent adjuster, neither insurer for the independent adjuster or for our client would cover the incident. And that was a bit appalling and shocking because they had a carve out for business email compromise that neither party even really understood or thought would be applicable.
Sorry, is the broker who advised to take out this policy of insurance also being sued?
So not yet. We haven't yet. We're waiting to see.
Basically, yeah.
We're waiting to see whether we can get a resolution through a different means. And then I hate to sue insurance companies, so we'll wait and see, and we'll wait to see if we need to bring in the broker. But certainly, it's going to be an issue. Again, what we don't do in our practice is try and advise on top of what the broker has advised. So we have clients who come to us and say, is this the best policy for me? And we definitely explain it to them, but we say you're going to have to defer to your broker if, explain that to them, because we're not taking on that risk. But that is an interesting question as lawyers. How much do we wade into these areas to help our clients understand what they do have coverage for?
Can I answer that?
Yes.
So I can't. So
I'll just call him and tell him to tell my client.
Our firm, Hall & Wilcox, has decided to dive into cyber, the cyber industry, the issue of cyber security. We historically have advice on privacy and privacy breaches, but we've recently taken on a partner who does claims work, and we've brought it all together. And if you Google HW Rampart, RAMPART, we're actually providing a full advisory service up front now, and we're collaborating with a bunch of experts to put all the parts together. It's all have a look on the webpage, and we're finding we're getting a lot of upfront advisory work, governance work. We're walking them through. Some of it may or may not be legal advice, and we're actually looking at potentially setting up a separate arm of our business. But we certainly have experts, so we walk through as a team. And for the insurance piece, we introduce a broker who provides the broker piece. And I just can't underestimate how significant an opportunity it is. And I know we're setting up a cyber security subgroup. And so I'd be interested to know whether other law firms have got it. But if you look in Australia alone, which isn't a large country, it's not a small country, but not a large country, there were 67,500 self-reported cyber incidents to our regulator in 2021 alone. and over $33 billion in cyber losses. There were 1,000 notifications to the privacy regulator, and the most targeted industries are health, finance, legal, accounting and management, personal services, education and insurance. So there's significant opportunity for all of us to provide a leading, emerging advisory service, which some other industries are doing, but where lawyers have a real advantage is we're real experts on the privacy piece and responding to the regulatory obligations, and we also provide the client privilege opportunity as well. So, yeah.
I mean, just picking up on Matt's point around sort of the scale of the problem. I was reading that the average cost of a ransomware attack, so you think about the cost of dealing with it, so the cost of the insurer, as well as paying the ransom, is $1.8 million. And that's sort of across all of them. I mean, that's absolutely huge. And this point goes back to where we started with the social inflation, which is, well, insurers are the ones that are being expected by the courts, by the public, by the policyholders to pay all of this. And insurers, yes, they've got pretty deep pockets, but there's not an infinite amount of cash there. So what we're seeing is that insurers now are beginning to potentially exclude ransomware attacks entirely from the scope of cyber policies, or they're providing sublimits. So instead of saying we'll cover you for $10 million each and every claim, they'll say that for everything but ransomware, where it will be $1 million, for instance. So insurers are having to tackle the social inflation problem by inserting exclusions, carve-outs, other limitations on the policies. And obviously that then that shifts the risk back onto policyholders. And if the policyholder wants to get the all singing, all dancing cover, they'll have to pay a lot more to get that. So there's this constant to and fro between insurers and policyholders to try to get the balance on these risks that are emerging, that are uncertain and changing all the time. It's a really tricky balance, and I can promise that insurers aren't always the bad guys. They're trying to do the right thing, but I'll let you be the judge of that. In terms of, so cyber is a sort of big concept. In the sort of cyber-related sphere, there's lots of sort of new stuff happening. Mills and Reeve, we've been involved in, for example, sort of tracing and preserving stolen crypto across the world, using kind of new developments in law and applying old school mechanisms to make that happen. There's some really exciting stuff going on. And I know that Erica, sort of historically, you've been involved in dealing with, I suppose, new emerging tech and innovation.
Yeah, so for example, in the blockchain world, what we're seeing now is a lot of these startups are creating a blockchain, issuing a token, and they want to go on and flip their business, but investors are looking for their D&O insurance policy because they don't want to be on the hook for some shady blockchain that's been set up. So the D&O policies are not cheap, and they can often sink a startup. So I don't know how many of you in the room are advising startups, but that's certainly a discussion to have with them, because as they're going through their process, setting up their structure, whether they have the proper insurance in place in order to get through various financing rounds is going to be key. And certainly, it's going to help them, hopefully, through their ESG policies, also guide what they're doing in their business. So I think there's lots of opportunity for all of us in the room. You don't have to be an emerging tech lawyer to be able to advise your clients. You just need to be twigged to the issues that you need to raise with them and say, have you thought of this and have you thought of that? Because at the end of the day, going back to the ransomware attack, my client had insurance. So if someone calls me and says I've been attacked, which I've trained most of my clients to do first and foremost, the next step is go to the insurer and report the claim and see what next steps need to happen. The actual ransomware amount was not covered. So they would pay a maximum of amount once paid. And that was something that again could cripple a business. So if your client doesn't have that rainy day fund or access to finance that ransomware payout, that could be huge implications from a privacy breach front, to be able to navigate your risk issues. So those are things I think we can all help our clients with, and also help then interact with their insurers and show their insurers, look, we've done all this. We have these policies in place. We have these systems in place. And why don't you tell your insurance or your broker about it? Because that may make gains on the premium front as well.
If I can also swing back to the risk for businesses of cyber attacks, it's not just the cost to the business and the potential loss of clients. We've actually had a recent case in Australia where the company itself, it was a financial services licensee holder and it had a bunch of authorised reps in the wealth business. And there were a bunch of cyber breaches for their authorised reps, and the actual licence holder was prosecuted personally for failure to have a adequate system in place, not to ensure no cyber attacks, but to minimise the risk of cyber attacks occurring. So again, that's a new risk that's emerging for our clients as financial services licence holders. So.
And actually, from an insurance perspective, we see a lot of cyber incidents falling for cover under professional indemnity policies, because precisely that, even though there is no established case law out there in the UK, and I think, Erica, you say Canada as well, effectively claimants are arguing that their law firm or their other service provider was negligent in failing to maintain adequate IT systems, and that is a matter that professional indemnity insurers should cover. They will argue then, well, no, that's a cyber matter and you get a dispute between insurers. But it's worth us, again, as lawyers, because ultimately, if we're working for clients where we're expecting to be paid ultimately by the insurers, we need to understand effectively who's our paymaster, where's this going? Do we need to think about whether we need to provide our client with a little nudge, not act as a broker, but just be aware of, well, we think you should actually be notifying this to your professional indemnity insurers. I think an understanding of how insurance works is really important if we're to provide that advice outside of the four corners, as David mentioned in the earlier panel discussion. We're conscious of time. We move on to the sort of the third, I would say, sort of final key issue. And to some extent, this is one that's evolved out of the chat, certainly that I've been having with you guys over the last couple of days. And as I think it was Kelly mentioned earlier today, many of you are corporate M&A. That's where the sort of most referrals happen. And all of you, and it was mentioned earlier, panel discussion, talk about W&I. And that's quite refreshing for me, because I sort of warranties and indemnities insurance has been on my radar for a long time, and it felt like sort of corporate maybe hadn't sort of, I don't know whether they were sort of dabbling in at the same extent, but now it feels that what started off as an insurance product that was very prohibitively expensive and would only apply to the absolutely huge deals has now been populated with many more insurers that are trying to get a slice of that market, which has driven premiums down, made it obviously then more affordable, and means that on many of your routine transactions, warranties and indemnities insurance is now very much a feature of that. And almost to the point where if you don't have it in place, you're exposing yourselves as corporate M&A advisors. And I don't know, I mean, just looking at the sort of other side of the world, Matt, is there a similar theme?
Yeah, I phoned a friend, I've got some stats here. One of my co-partners runs our W&I book, and he reported that over the last 12 months in Australia, the W&I take-up has gone from strength to strength. I didn't think to ask him whether or not it's because there's more private equity involved in transactions and whether or not they use that as a bit of a safeguard in case things go wrong. But certainly in Australia, and the M&A lawyers would be happy to know that There are about 250 insured deals with an average deal value of just under 300 million last year in Australia, on an average deal. And one of the brokers was telling us that they have about $1 billion plus in deals lined up where there's going to be W&I insurance. So the take-up's really increasing. The rates are around 1.3% of the covered insured amount. So not 1.3% of the deal, but the level of cover. And there's about 15 to 20% of the policies do have claims on them. And I think an earlier session was touching upon experiences there. So
I think it was Sophia of sort of our host firm in Portugal is mentioning sort of pay particular attention to is there cover for tax liabilities, and in fact that is incredibly important because I sort of looked at a few stats, and of all the notifications that are made to insurers under W&I policies, 33% of those, so the greatest number, are in relation to tax representations that have been made. And typically because you have the tax authorities that are, after the event, after the completion has gone through, reviewing historic tax accounts and finding problems. And that's generating big losses for the purchaser of the target company. So I think that Sophia made the point very well. Check that you've got your tax liability there, or if you actually need, so insurers have developed it again, because they try to help everyone, tax liability insurance that's standalone outside of the W&I. So solutions are always available.
And as the advisors, it's probably not a bad thing for us, for the client to have a level of W&I cover, especially for some of those technical areas like tax.
I think just to close, the point that kind of brings us all together is that there are actually, David brought up in our preparation call, differences between our jurisdictions. And so if you are also dealing with a multi-jurisdictional client who has a primary or excess insurer, it may be handled differently. So I don't know if you wanted to just close with that, David, because I thought that would maybe give us something to think about if we're doing cross-border deals.
In terms of having
whether one gets exhausted first, and you were saying that in Canada it's different, or maybe North America.
In terms of the erosion of
the limits.
Of the limits. So in Canada, one of the difficulties is that that you have defence costs will be paid by whichever layer of insurance is the active layer, until that layer is fully eroded, which means that in Canada you can have a claim, a cyber claim, which might run on throughout the duration of it, and only then at the end of it is there a payment that's paid out. So that means that the primary is on the hook the whole way through until you pay out for all of the defence costs. And then excess layers can say, well, no, we're not liable for any of the payments. It's a draconian Canadian piece of a law. Yeah.
But
I think the point there is that different jurisdictions do things in different ways. So because of the nature of the insurance industry, where you'll often find that you'll have your local, what we might call fronting insurer in your own jurisdiction, they will effectively, often they will reinsure or insure back into London or a different market. So you'll have insurers in different jurisdictions on the same risk. Understanding how they operate can be crucial to managing your client's cash flow and the indemnity that they secure under a policy. So that's where we as kind of best friends can liaise and just get that sort of understanding. I was hoping I'd be in Alina's good books by finishing 30 seconds short, but now we're a minute over. So I fear that it's gone horribly wrong.